Warby Parker, which makes glasses, filed their S1 yesterday, and they're planning on going public by direct listing. Somewhere Bill Gurley is having a nice ice cold beer, kicking his feet up and feeling great. So before we get into this Warby Parker, let's do just a quick primer on direct listings. There have been 5 notable companies that recently went public via a direct listing: Spotify, Slack, Palantir, Roblox, and Coinbase. Spotify back in 2018, a true pioneer. Slack in 2019, Palantir in 2020, and then Roblox and Coinbase in 2021. So we're averaging about 1.5 of these a year, but it seems to be ramping up. Obviously, if Warby Parker goes out this year, there would be 3 major direct listings. Let's break down the differences between a direct listing and a traditional IPO, initial public offering. When you go public via a direct listing, you don't have intermediaries, i.e. investment banks, underwriting your shares. So this is a little bit risky because without the intermediary, there is no safety net guaranteeing the shares will sell. You don't go on the same, what do they call the tour? You don't go on the same road show. You don't have the blessing of the big Goldman Sachs, et cetera. For this reason, companies that direct list have to have strong brands and some level of notoriety. Obviously, with Spotify and Coinbase and Slack and Roblox, you have very high profile companies. They don't need to be sold because they have a massive footprint. Anybody who's in the stock market knows those companies well. Now, with direct listings, you also have no lockup periods. That is great for early employees and investors like myself. In traditional IPOs, there's a lockup period, and that's between 90 and 180 days. Basically, 6 months is what you can expect. That means when Robinhood goes public or Uber went public, I can't sell my shares. Neither can the folks who worked for a decade or like me, angel invested and held my shares for a decade. We can't sell. Who can sell? The banks. The banks that took it public and their customers and clients who they let have friends and family shares and they can flip them. How is that fair? That makes no sense. It's complete hypocrisy. It's complete inner kind of inside baseball dealing. It just screams of unfairness. Now, direct listings also have no further dilution for shareholders. In an IPO, you're giving new shares of the company that are created, and that dilutes existing shareholders. Of course, you get money for those. In a direct listing, you're basically saying, here are all the shares that are available. We got 100 million shares or 1 billion shares of Spotify. Have at it. Start trading them. Now, direct listings are also much less expensive. They take less time and money than a traditional IPO. And in an IPO, these investment banks charge an underwriting fee to do this whole process for finding all these investors for you. And the underwriting fees are charged on a percentage basis based on how large the IPO is. The more money the company raises, the lower percentage of the fees. PwC, PricewaterhouseCoopers, recently published an IPO price calculator on their website based on the average of 829 IPOs. And in deals greater than $1 billion, the average underwriter fee was 3.5%. And the average investment banks on a deal were 16. So based on this, you're spending $35 million making your shares available. According to Andreessen Horowitz's breakdown, apparently that's some venture firm in Silicon Valley. I haven't heard of them yet. Their direct listings charge a flat advisory fee, which is typically half of what the smallest underwriting fee for an IPO would be. Are you concerned about your portfolio's performance in the near future? JP Morgan, BlackRock, and others are projecting public equity returns of just 3 to 5% over the next 5 years. Analysts at Bank of America urged investors to consider real assets as part of an inflation strategy. So, where are the major players putting their money? Endowments for Yale, Harvard, and other top asset managers are looking into alternative assets. According to Masterworks research, endowments over $1 billion are investing 55% more in alternatives on average. If you're looking for a very interesting asset class that's uncorrelated with the stock market, it's blue chip art. Masterworks.io sells shares in multi-million-dollar paintings by artists like Banksy, Picasso, and Warhol. According to Masterworks, contemporary art has appreciated 14% annually from 1995 to 2020, outperforming other real assets like real estate and gold. I just had the founder, Scott Lynn, on the program again, episode 1232 for an alternative assets roundtable, and he shared some great insights around inflation, appreciation, and more. Go listen to episode 1232. Masterworks.io is a fantastic idea, and they're executing at a super high level. I think it's really genius. So sign up today at Masterworks.io, and if you use the code TWIST, you'll skip their 30 1,000 person waitlist. See important information at masterworks.io/disclaimer. So let's dive into Warby Parker's S1. The LTM revenue, in other words, the trailing last 12 months of revenue, that's typically how we would say it in the business,